Hey everyone, happy Friday. This is Tim Dial. I just wanted to give a quick and short update on what's going on right now in the markets as we head into the weekend. Obviously, we had some good news that hit earlier this week, and we saw a couple of nice days of improvement there. Today, we took a step back a little bit, but it was a lot worse earlier in the day, and we've recovered nicely in the latter part of the day. So at one point today, I think we were down close to 20 basis points, and on the you know on the mortgage bonds, which impacts the 30-year interest rates. So now it's only 6 basis points, and I believe the markets have closed now, so that's where it should remain. So that's a nice recovery. We got like 14 of them back, which is great. Now there was also some news that came out today from one of the Fed governors, Waller. He did talk earlier today, and a lot of what he said was actually positive news for the market. Maybe that's what moved it back to the better direction, even though we didn't make up all of the losses. But what he said was that a lot of the data that's been coming out is not as strong as the headline shows it to be. And as a result, he could see there being 3 to 4 rate cuts in the coming year, or this year. I guess we're already into this year. So he said he could see there being 3 to 4 rate cuts this year. Even though they may wait a couple months, you may not see the first one until like March, I think he was saying. But that was positive news, because the last Fed meeting they said that they probably only see like 2 rate cuts this year, and that's after previously they said they'd probably make 4 to 5. So now Waller's saying maybe 3 to 4, which is better than what the Fed said last time. So the data keeps changing, and as the data keeps changing, they keep changing their mind on this kind of stuff. Which is what you can expect. I still believe that they're going to make more than 4. And I also believe that they may not make only 25 basis point cuts. I think you might see some 50, possibly even a 75 basis point cut, because they're not factoring in the possibility of a recession. And if a recession happens, which I think it will, then you're going to see the rate cuts become more aggressive than what they've talked about at all, because they're not factoring in recession into it at all. So, and the reason they're not is because a lot of the data looks positive from their point of view, because one thing they never look at is what's going on with Americans and their debt. And right now, the Americans have more debt than they've ever had as far as credit card debt, and additionally, the people who have missed payments is higher than it's been since the Great Recession. So that's a big red flag, and they don't pay any attention to that. So eventually, people are going to have to stop living off the credit cards. When that happens, they're going to stop buying as much, and when that happens, you're going to see the possibility of a recession take place. Now, what I've said before, and this is still true, is that whenever that happens, a lot of times you may go into a recession and they don't announce it for 3 or 4 months, because they have to have the data catch up to whatever month we're into. And so they're always looking backward. And so sometimes they don't really know for sure you're in a recession for like 3 months until after it happens. So, we could go into a recession, say April. They may not announce it until August, or something like that. So when that happens, you'll see aggressive rate cuts in the latter part of the year if that happens. So we'll just have to see how that all kind of plays out. But we may be able to tell from data that we're approaching it before they announce it, So, we keep a good eye on that kind of stuff. But anyway, let me share the screen with you here just to go through this quickly. Let's see, so it's the screen. So as you can see here, this is what the markets are looking like. On the 30-year, we want to see the 30-year going up. That means rates go down. That's a 30-year bond. So you see we made some really nice gains these last 3 days, some really nice gains here. And then we did give a little bit back today, but we were a lot worse. We were way down here, and then we recovered to back to here. And hopefully we can get back above this line and stay above it. That would be very positive. And then the other thing we look at is the 10-year. 10-year didn't move a whole lot today. We did lose a little bit. We want it going down. It goes the same direction as the rates. So we want it going down. It came up just a slight bit today, 2 basis points, not a huge deal. But we want it to try to get below this line and then stay there. That's where we want it to be. And then hopefully we can keep going in that direction. But wanted to go over that real quickly. Didn't want to take a ton of your time, but it is, we are going into the weekend, so I thought I'd give a little bit of an update. If anybody needs anything over the weekend, I will be working and I will be available. Just let me know if you have any questions. I will talk to you later. Thanks. Bye.